If you own investment real estate, say a rental home, a short-term rental, a duplex, even a small commercial building, there's a good chance you're overpaying on your taxes. Not because you're doing anything wrong. It's just that most properties are depreciated the default way. And the default way leaves money on the table. Let me show you how this works. When you buy a rental property, the IRS says the building is depreciated over 27 and a half years for residential or 39 years for commercial. So, most investors take a small deduction every year for decades. But here's the part many people don't realize. Not everything inside a property is actually a 27 and a half year asset. Things like cabinetry, specialty electrical, plumbing fixtures, landscaping, driveways, appliances. Those are typically 5 or 15-year property under the IRS tax code. A cost segregation study identifies those shorter life components and reclassifies them into the correct depreciation category. That front loads your deductions into the early years of ownership instead of spreading them out over decades. Large apartment developers and hotel owners have used this strategy for over 30 years. We're simply applying the same engineering methodology to everyday investment properties. Let me put some real numbers on this. A single family rental purchased for $485,000, a cost seg study identified over 62 grand in assets that could be reclassified to faster depreciation schedules. At a 37% tax bracket, that's roughly $23,000 in potential first-year tax benefit. A furnished short-term rental at $575,000, 137 grand in reclassified assets. Potential tax benefit over $50,000. A fourplex at $680,000, 105,000 reclassified. Potential tax benefit roughly $39,000. The range varies by property, but most studies identify 20 to 40% of the building's depreciable basis as shorter life assets. And here's what makes right now especially powerful. Under current tax law, 100% bonus depreciation has been permanently restored. That means qualifying assets identified in a cost seg study can be deducted in full in the first year, no spreading it out. One thing worth noting, if you own a short-term rental where the average guest stay is 7 days or less, and you materially participate in managing it, your property may be treated as a non-passive activity. That means the depreciation deductions could potentially offset your W-2 or business income, not just rental income. Check with your CPA on whether your specific situation qualifies. And if you're thinking, I bought my property a few years ago, did I miss the opportunity? You didn't. Your CPA can file Form 3115, which allows you to catch up on depreciation you should have taken in prior years, all in a single tax year. No amended returns required. If you decide to move forward, the process is simple. You place an order on our site. It takes about 5 minutes. We run an engineering-based analysis of the property and deliver a CPA-ready report within 48 hours. Your CPA attaches the report to your return and handles the filing. Traditional cost segregation firms charge $3,000 to $7,000. We're a fraction of that. And every study comes with our CPA-ready guarantee. If your CPA requests changes, we'll revise the study until they're satisfied at no additional cost. If we can't produce a report your CPA will accept, you get a full refund. If you ran an estimate on our site, check your email. We sent you your projected deduction. If you want to convert that estimate into a full cost segregation study, the order link's in the email. If not, start with the free estimate on our site. And if you have any questions, just reply. We're happy to help.